Good morning. It's Wednesday, 1st of August 2018. Welcome to our second special webinar, Admiral Markets special about ESMA. Today we will speak about trading strategies after ESMA, day trading live with new leverages, and maybe all your questions you might have around the new topic CFD regulation about ESMA in European Union starting from August 2018. So let's have a nice start. We will have start with risk warning, and today we have two moderators. Also, day trader Jens Klatt will be main moderator today. So good morning, good day also to Jens Klatt. And before we will speak also, let's start with a risk disclaimer. Forex and CFDs are leverage instruments and can result in losses that exceed your deposits if you're a professional client. From the ESMA regulation from today or from this week, we will have differences between retail client and professional clients. So also now important to check if you're a retail client or a professional client. More about later here in that webinar. If you'd like to read the full disclaimer, just visit our web pages, for example, admiralmarkets.com, and you will find everything written down there. Yeah, like I said, retail clients, professional clients, big differences. We will speak about that in our webinar here. And if you have any questions about that live in the webinar, please type down your questions with your keyboard. And we are really happy to answer all your live questions here. This is me. My name is Jens. I'm the Berlin guy, the German guy from Admiral Markets. We are a big international broker, over 18 country offices. So yes, maybe you hear my accent. I'm a German guy. And yeah, we have also a second German guy, Jens Klatt. We both have the first name, the same one. And yeah, good morning, Jens. Maybe you want to say something before we are going through our presentation.
Yes, good morning also from my end. And the funny thing is that we not only have the first name in common, but I'm located in Berlin too. What shall I say? Good morning, and the weather is very sunny over here, so everything's fine.
But we not only have Jenses, we have also Jace and Pauls and Giancarlos and Marcus and Dirk. So we have many more webinars. For example, real-time daily trading ideas every day, every business day to the same time. German time 11 o'clock, Eastern European time 12 o'clock, or London time 10 o'clock. It's a global webinar, so wherever you are on the globus, you can join and see our leading day traders live. And of course, if you like to trade Forex and CFDs, you will get many benefits only with us. Like some other brokers also, we have now different options and offers for retail clients and professional clients. How you will learn in this webinar also, retail clients will have a maximum leverage to choose in European Union up to 30 for Forex majors, and the professional clients still have the option to choose the high leverage up to 500. More couple of seconds or minutes later here, but the spreads will be the same for all of them. So one example, DAX 30, one of our bestseller, typical spread of just 0.8 points during the main trading hours, or euro dollar, also right now typical spread of just 0.8 points without any commission additional. Check all that out on admiralmarkets.com, or speak with us or send us an email. Everything is possible, and everything is of course to find and linked on admiralmarkets.com. So what we are talking about, ESMA, important changes. The time is now. Starting from that week, all CFD providers in the whole European Union switched and implemented the new regulation by ESMA. Like said already, retail clients, and that is a default status, have now a maximum leverage to choose of up to 30 for Forex majors, and for other instruments like, for example, index CFDs, even lower, just up to 20. Same for gold. If you are an active and professional trader, you can apply for the professional client status, and then nothing has to change. If you get the status, then you still have the option to get the higher leverage. And sometimes the picture says more than 1,000 words, like we say in Germany, but maybe also in some other regions of the world. So example, if you traded the DAX 30 CFD before with a leverage of 500, you just had a margin requirement of 24 euros. And now, with a new leverage of 20 only, the new margin requirement will be 600. That's a big step. Same for euro dollar. If you traded with a maximum leverage of 500 so far, just 200 euro margin requirement, and new 3,333 euro. I guess that picture say more than 1,000 words. And if you have questions about that, like I said, please type down your questions live in this webinar. Main topic in the webinar will be that we will speak about how to make day trading, how to make trading strategies after this new ESMA regulations. But before we go to that, here also an overview about the options and the differences. Retail clients will have a big benefit about unlimited protection against negative balances. It depends at which broker you have your trading account. Some brokers don't have any additional protection for professional clients, but some brokers like Admiral Markets will have an additional protection, like we have here, up to 50,000 British pounds. It's round about 70,000 euro. We have a negative balance protection policy, so also our professional clients get a great protection against negative balances. Also here a link, if you check it out, you will find more about that, and also how you can apply for the professional client status if you decide to run for that. But now I will give the main word for Jens, and maybe I have just a comment from time to time, because now we are looking forward about trading strategies and how to make day trading with this new ESMA effort. So Jens Klatt, now it's your word.
Okay, perfect. I just wonder if I probably should take over the screen too, because I want to show yeah, the most sense, as you said, a picture says more than 1,000 words. Okay, so there we go. Yes, so what you can already see here is a trade I entered in the morning based on the strategy I will present here, respectively, which was already presented in a webinar, or several webinars, in fact, and in several live trading occasions here we held together over the last weeks. We are talking about something which some of you might have heard about already in trading. It's called the open range breakout. That was a trading approach. Yeah, it wasn't really invented, but studied in detail is probably the better word for this. From a guy today, a hedge fund manager and managing over $1 billion US. His name is Toby Cravel, and he found out that the markets, yeah, they tend to build around the opening phase, around the some might call it auction process. When markets open, spot markets open, that they tend to build a trading range. And after the market breaks out of this range, the market tends to move in the direction of the breakout for a certain amount of points of the range before. More than often, it's at least 1 R. So how do we find 1 R? 1 R is the difference from the high to the low in this case. And if in this example, for example, is 35 points, then it means that the market will at least move 35 points in direction of the breakout. In this case, we broke it on the downside. So the interesting thing is that you can already spot here that the difference I used there is obviously not only 1 R for the take profit, but I'm working with a 2 R take profit level. And based on the webinars we held already, we know that this is a profitable approach too. And what we've seen is that the market broke out already here. That was or is around 1 hour ago. And then it moved here down to 12,768. The breakout occurred here at this level. That was 12,806 or 805, I'm sorry. So with a stop loss there, you can see it here already. That's 35 points. This is the risk then in this case. And the interesting thing is that the market obviously moved, in this case, slightly more than only 1 R, 40 points instead of 35 points, but it really moved this difference already. So based on this simple approach, where we just say we duplicate this range, we would have generated already a profitable trade here. So this is the main idea behind this. I've prepared already some slides, so I will give you an idea of how this works in theory here to screenshot it, or I can also give you a link. In the morning, there was an article published on Admiral Markets website in the education section, where you can find this approach being traded on a real example from around 1 month ago. That was on the 5th of July. That was a really great example how the strategy works. And but what we want to focus on here is the ESMA decision and how it affects our trading. And Jens has already shown it here before, that the margin requirements now increased significantly. Nevertheless, I can already talk about what we will see in the end. It does not affect our approach at all. And in fact, it's also possible to trade it on several markets. It's slightly different, in fact, when we are trading this approach from several ranges, and let's call it scalping, or with a scalping attitude. So this is something we want to have a look at on Friday then. But in this case, I can already say it does not affect our trading strategy. But what it does is it obviously bans or bounds more capital. I'm not sure. So it's in Germany the word is binden. I think it's bound. So it's more capital which is bound, even though it's still possible to trade this approach here. And we will, by the way, also see in the upcoming minutes then that it's probably not the worst decision to increase the leverage, in fact, because it increases the overall longevity of a retail trader. And I'm not only talking about a small percentage, but significantly. Nevertheless, first of all, let's have a look here what just happened. So this is German. Kontostand is for balance in this case. Some of you might be familiar with this when looking at it. I think the only thing which has changed is the wording here. And what you can see is here, this is the margin. It's 512.20 euros, which I need to pull up to build a position in this case of 2 DAX CFDs here. And this is, it's a very, very simple way, in fact, how it is calculated. So we can, or I prepared here a Word document already, and let's do it that way. So currently the DAX is trading around 12,800 points, and this equals to, well, we're talking about a CFD, which is the equivalent, if I'm talking about one CFD, of a value, of an overall value I trade here of 12,800. Okay, so in this case, that means that this is the amount I'm currently trading here. So 12,800 euros. And so before we had a leverage. The example from Jens was 500 to 1. Probably we go down to 101. So you can choose which leverage you want to use in your trading. In case of leverage 100 to 1, it's easier to calculate with this. Even though, I mean, we could easily divide 12,800 by 500 here too and get a number. But I think with 100, it's easier to get a number then. And if we divide 12,800 euros by 100, you see that you have to put up, and I write this right behind there, margin requirement. So this is the margin which is required to build a position of 1 DAX CFD. So in our example, we're talking about 2 DAX CFDs, and this means that we duplicate this number. Then we multiply 12,800 by 2, and we get. Oh, we can make it a little easier. So we can switch this step, by the way. So we can just take those 121 euros, multiply this by 2, and then you can see that you only have to put up 256 euros. So that was before ESMA. Probably that makes sense to write it that way, before ESMA. So, and now the question is, what happens after ESMA? And in fact, this calculation only changes because now the leverage restriction for retail clients, not for professionals, but for retail clients, we don't need this. The leverage is 20 to 1. So as you can see, you have obviously then to change this calculation here. We can copy paste this, and we don't divide it by 100, but we divide it by 20 now. And if we divide 12,800 by 20, you can see that then the margin requirement in this case here is 640 euros. Margin you have to pull up. By the way, you can by the way spot already that my account here has obviously not switched to ESMA right now, because I have only to put up 512 which means that my leverage I'm using here is 1 to 50. But I can already tell you what is the reason for that. So by the way, if I open an account, I do not exceed this level of 50 to 1, because for my trading it's completely, I think the right word is irrelevant. So it doesn't really matter, because my trading is based on a very, very balanced leverage in general. And that has something to do with a chart I will show you a little later on, because I know how the overall leverage affects the overall profitability.
I guess you have a small calculation mistake. Why? Because it's 36 degrees in Berlin, so I guess in whole Europe it's too hot. If you calculate with 2 CFDs, you have to multiply also 640 with 2, so it will be 1,280.
Yes, sure. So I just wanted to make sure here in this case why here in this is only 500 euros. So some of the attendees probably have problem to understand that. Then I just wanted to make sure that there's no issue now with the understanding why here's 500.
Absolutely, yeah. But if you have in the first example 2 CFDs, you should also have it then in the second one. That's why I'm saying that.
Okay, so let's do it then here. So 640, and then it's 1,280. So now it's perfect.
Yes.
Yeah, and so the reason why I reduce the leverage right in the moment when I also work with the demo account, but also when applying for a live account, for example, in the past, was because I know how how obviously, to some extent, the leverage affects the overall profitability. But something, I jump a little. So first of all, I want to make sure that you get an idea here of what happens right now after the ESMA decision. You see that in the example, with a leverage of 100 to 1. So by the way, we could also probably even make more sense than that. No, it doesn't make sense. And so I could now show you, if you divide this number by 2, you have to multiply it then here by 2, and then you get those 512 euros, as you can see in the MetaTrader right now. But what you can see is obviously that the margin requirement now multiplied by 5, because the difference, or the ratio of 100 to 20 is 5 in this case. And as you can see, 1,280 is 5 times bigger than 256. But another thing, in my case, for example, I'm here referring to a 10,000 euro account, slightly lower than that. And that means that I'm obviously working with an overall risk, which I already agreed on for myself. So based on my personal risk aversion, I say I'm only willing to take a risk of 1% per trade. In case of a 10,000 euro account, that means that I'm only willing to take a risk per position up to 100 euros. And so in this case, by the way, it's slightly below that because it's 35 points. And if you multiply it with 2 CFDs, where 1 point equals to 2 euros, the overall risk for this position is 70 euros then. So if you work that way, you obviously have no trouble to deal with the new ESMA regulation, because if you do not exceed a certain risk threshold, let's say, you're somehow not really affected by that. If you're only trading one strategy, if you're trading 2 strategies, things start to get a little more difficult, even though it's, as we will see in the example later on, it's not such a big difference. But from there, and again, if you're trading more than 2 strategies, scalping strategy, it could be one strategy, but several trades you do with a risk of, let's say, 1%, something we'll see on Friday, then you probably run into trouble here. And the only thing to really positively take an impact on this is by reducing the position size, or capitalize your account with an adequate amount so that you do not run into any margin problems. But overall, I can say that if you follow certain, let's call it certain rules of risk and money management, because I'm not a big friend of saying only risk 1% per trade, even though in my trading this is the case. So I'm not risking more than 1% per trade, respectively. I'm not risking more than 2% for all strategies I trade in account. And the reason for that is because I put the risk first, and I try to, based on my personal risk level here, I try to get a risk in my trading, which is perfectly fine with my overall personality. And try that way, by the way, and that's something you can show then from a mathematical standpoint to get a smoother equity curve. So the risk reward is let's say it's a quite stable and really nice number if you work with such numbers.
Maybe you can go back to your Word document, and I like to point something out again. Like you see, Jens and me will play ping pong. Sometimes I have a comment. So again, bottom line, I like to point it out. If you like to trade as a retail client as before, maybe you only have one option. If you like to trade like before, you need more account balance, if it's possible for you. So if you like to trade like before, no changings, you need a higher account balance. If it's not possible for you, because not anybody has 10 or 20K free trading capital for trading, then the only other option is to lower the volume. If you traded maybe DAX 30, 5 contracts or 10 contracts so far, then maybe you have to check out if now the new volume could be 1.5 or 0.6 or whatever. You have to find your new volume for your personal trading. Thank God at Admiral Markets, you also have mini lots. So not only Forex you can trade with mini or micro lots, even index CFDs starting from 0.1. Not all brokers have that option. So usually you will find your own personal trading volume. But of course, best would be if it's possible for you having a higher account balance. This is a big two options. Last third option, it's maybe not an option for all of you, but I will also mention it again. If you are a professional trader and you know about the risk, you can check out the criteria who are applying for professional client status, and then nothing need to change, because then you still can choose a higher leverage up to 500. It's just the up to. If you like to get a lower leverage as a professional client, it's possible with Admiral Markets. Again, not at all the competitors, but at us, you can also choose a lower leverage, like just 50 or 100 as professional client. Back to Jens Klatt.
Yes. So let's go here. So no, I've already talked about the strategy itself, how it works in reality, to give you already a picture. But nevertheless, I already said that we want to go through this 3-step way here to formulate the setup again for the DAX. But we will also adapt this to the S&P 500 a little later on. So in fact, it's the same approach. Toby Kraber, when he discovered and studied this open range setup here, or range breakout system, you can also call it that way, because you can also adopt it to the FX markets, for example. And you will obviously find out that the FX is traded around the clock. So there's no real open range. You can easily say, okay, but the market opens at, in our case, 11 p.m. German time every evening or night. And this is the opening range. But the only problem with this is that there's usually not enough liquidity in the FX markets, and markets tend to really spike higher and lower, but there's no real significance in those moves here. But you can find approaches, for example, the so-called Asia breakouts, to adopt it then to the FX markets. You can also adopt it, for example, to equities. It's also an option. You can trade equities, so single share CFDs, but also physical stocks at Admiral Markets. And based on the fact that yesterday, for example, yesterday, that Apple gave their quarterly earnings report to the public, you can also adopt it to highly liquid and deep equity markets in this case, and then formulate a trading approach which is similar to the one in the S&P, for example. So there's plenty of chances to adopt the strategy. We here in this case only want to focus on 2 examples, which will show you that with the ESMA decision, while you're only taking 1 trade with 1% risk per day with each of these 2 strategies, you do not run into trouble. The moment you trade more strategies, and that is what Jens was referring to here, that the more strategies you trade, and if your trading is built on this, obviously you rather sooner or later run into trouble because of the higher margin requirements, and that you have no other choice than to reduce the position size or capitalize your account with a higher amount. So now let's focus here again on those 3 steps. So what did we just do based on what the trade was built here? In the first step, I defined an open range between 8 and 9 a.m. your German time in this case. So you can see it here with those 2 purple lines. It's not purple, I think it's pink. And there's the high, and there is the low of this candle. Okay, so here. Then what you can see, the second step, it's important to identify an advantage. What I do in this case of the DAX, based on the 5-minute exponential moving average 50. So that means very simple. If we trade above, we go only long, and if we trade below, we only trade the short side. So as you can see here, this is the blue line. We were slightly, you can't really see it because here in this candle, there's a small blue dot, but we closed below this. So if you go on this candle, you can see that oh, by the way, is the candle? No. Can I see the? In this case, that's a little. There we go. So it's 12,809.4, and the close of the candle was, I'm not sure if this is right. No, unfortunately, that's not right. So what I want to do, usually when you here go on this candle, for example, what you can spot then is the reading of the exponential moving average. The only problem is that I did a test trade within this candle here, and that's why I can't show it. Okay, but what you can see if you zoom really sharp into the chart is that we closed slightly below this blue line, and the close slightly below this blue line means that we only trade the short side. So what we do is we place an sell stop order in this case at the low of this range we defined in 1 here, and we place the stop then above the high of this range. And in case of the DAX, that's something which is not mentioned in here, but in case of the DAX, we also place a take profit level which is 2 to 1. In distance of 2 to 1 from the entry point. So the risk reward of 1 to 2 in this case, or if we define the high and the low of the range with 1R, we go for 2R in this case. So or to take numbers, this is 35 points risk, and then with this entry point here, we place our take profit level 75 points away. In this case, then it means we enter the market at 805. We have the stop loss at 840. This is the range. And then we place the take profit 70 points away from this entry price, which is 12,735. And this is in fact exactly what just happened here and how we entered the market. And so to give another example, not only the example from today, we can also use this chart here. In this case, it's the long side. So this is really great because we have a short trade going right now as a practical example right here. But the example, the screenshot here is with the long side. So you can adopt it to both sides, obviously. And in this case, really, the market then also hits the take profit level here on the upside. By the way, then this is something I want to share with you here. So the website from Admiral Markets, you can here find within the analytics region and then the traders block. This is here, analytics, and then there's the traders block. You can find trading the DAX 30 with the open range breakout. I want to share with you this link. So I call it DAX 30 ORB, that's open range breakout, and I just copy paste here the link into the chat box. So you can easily now, if you say, well, that's a little fast, is there a chance for me to probably take some time on this and read through this in detail here? Yes, just check this article here on the website from Admiral, just published freshly around 1.5 hours ago, and you can then in-depth study this approach here. By the way, with this chart, so you can easily do this, and also so you look at the recording of this webinar in the YouTube channel shortly after this webinar ends here in around, let's say, 2 hours from now or something. You can also go through the example then for today to just get an even better understanding of this. So to get, and this is nevertheless the reason why we want to, or why we're having this webinar here, is nevertheless to get a better understanding of, again, how does the ESMA decision affect your overall margin requirement in this case. And so in this case, we were trading 500 points lower. So we will see that obviously with the index reading here, the overall margin requirement is affected. And so we go through these steps now with the example. We define the open range on this day, the 5th of July then, between 12,309 and 12,371. You can see that the range is 62 points, so it's wider than today. It's nearly twice as much because today it's 35 points. Here on the 5th of July it was 62. The point value, again, is €1. So for one full DAX CFD, what do I mean by the word full? That was something Jens mentioned before. At Admiral, it's also possible to trade so-called mini and micro DAX CFDs, so with a point value of only 10 cents, which is, by the way, a great way to adopt your strategy from a position perspective, by the way. Then this day, we'll see that the DAX trades above the exponential moving average 50. We trade only long setups, as mentioned before, and then we now do this ESMA calculation before ESMA, and obviously it was, by the way, before ESMA. So the trade took place on the 5th of July. We have one DAX CFD, which has then 12,309 euro value, based on the fact for one CFD in this case, which amount do we move here in the market. And then if we say we work with a leverage of 100 to 1, for example, to make the calculation easier, the margin for one DAX CFD in this case was 12,309 divided by 100, and you get 123.09, but let's skip this difference here. And then we assume that we're trading a 10,000 euro account, and we have 1% risk per trade. And again, this is great, and this is also something which is really interesting when you have a broker like Admiral offering micro DAX and the point value of 10 cents per point. You can fractionize your position in this case in the DAX. So it's not necessary that you go down to one CFD or that you round up to 2 CFDs, but you can trade 1.6 CFDs. And so in this case, nevertheless, one risk per trade means that you're willing to risk max of 100 euros in this trade. So if you start your calculation of the overall risk here at this point where you say, I risk 1% per trade, everything else starts to fall into place already. And you're not necessarily affected by the ESMA decision. It really only becomes a problem if the position size you take is in fact too big, let's call it, too big from a percentage perspective. So probably there are trading approaches which trade with a higher percentage risk, even though I can say based on my experience that usually you should start from the point where you define the risk for yourself and go from there. And then you say, okay, this is the point risk. So in this case, it's 62 points. And if I have a point value of €1 and I'm willing to risk, or I take an over risk of 100 euros, that means that I take 100 euros divided by 62 and get 1.6 CFDs, making sure that I'm not risking more than those 100 euros I'm willing to lose. And again, with this old calculation then, the required margin was 1.6 multiplied with 103.09 euros. That was the that was the margin for one DAX CFD. And so you have to, or had to put up 198.53 euros. So now let's assume it's not the 5th of July, but it's the 5th of August after the ESMA decision, and you're still a retail client, so you're not professionalized. That means in this case that this changes now because the leverage was reduced from 100 to a max of 20 to 1. So if you now calculate the point value of the DAX again, it's the same, 12,309 euro, you're moving here. And now with the leverage of 20 to 1, you have a margin there for one DAX CFD then from 12,309 divided by 20 or 5 times 123, so 615 euros, 0.45. Again, we assume that we have a 10,000 euro account and we have 1% risk per trade. So if we now divide those 100 by 62, we again get 1.6 CFDs we are trading. So also this does not change, but the margin requirement increases because now we multiply the margin here from 615 with 1.6 and we get 984.72. What you can see, by the way, let's switch back to the Word document. Again, it's 500 points higher we're currently trading. So what you can see is that obviously with an increasing DAX, the margin requirement rises while it drops on the other hand if the DAX drops. So this is, by the way, something you should take into account and why you should definitely give yourself more of a I think it's called buffer, so that you're especially in times of higher volatility, when the point value of the DAX rises and probably drops several hundred points within days, that you take this into account here when capitalizing your account. So that was then the bottom line is more capital is bound, 5 times more. No surprise, because leverage 100 to 1 is reduced to 20 to 1, but the strategy is still and easily tradable because we, in both times and in both cases, we assumed a 10,000 euro account, and you can easily afford this, let's say. So saying I have a 10,000 euro account, and if I pull up a margin of nearly 200 euros or 1,000 euros, it doesn't make a big difference because I still have enough money in my account, and I'm not wiped out here by a strong move in one or the other direction, taking into account that I'm working with a clear stop loss, which I place in the market, and so everything is fine. It's still easily tradable, the strategy. So this is in one case. Now let's assume, and this is in most, and it's by the way, it's not only that it's in most cases like the case here, but it's also the fact that many traders do something which is definitely recommendable. They are trading more strategies respectively, probably trade the same strategy but on different asset classes. Like I already said, focusing on the DAX here, then we can also trade the open range breakout in the S&P, we can trade it in the FX market, and so on and so on and so forth. The great thing about this is that we do something which Markowitz once introduced as diversification. We do diversification here, and this is already a good starting point to smoothen the equity curve, to reduce the potential drawdowns in our trading, but also to smooth the equity curve that way, and get a better risk reward, an overall risk reward. Based on that, what we do is now we adopt the strategy to the SP 500 here for Admiral, and we define the open range again. You will see that it now nevertheless changes, because now we are looking at the opening auction here in the US equity markets, and the US equity markets open, Wall Street opens at 3:30 p.m. German time, and we wait for the first 45 minutes here to trade, and after that we have a high and we have a low again. Then we identify the advantage based on a 50-minute exponential moving average here, on a exponential moving average 10 in this case. So remember, in case of the DAX, it was a 5-minute chart and an EMA 50. And then, simple again, identification of the advantage. If the S&P trades above, we only go long. If it trades below, we only go short. And then the third step, again, is we trade the breakout of the range in direction of our identified advantage. So meaning open range high and low. If we trade above the exponential moving average 10 on a 50-minute time frame, we trade the breakout on the upside if it occurs. If we trade below, then we trade the breakout on the downside. We place the stop accordingly above or below the high low of the range. And this is something which is also different from the approach in the DAX then. In case of the DAX, we work with a take profit level of 2 Rs, which means if we define the open range, we have 1 R, and we multiply this range with 2 and get our take profit level. In case of the S&P, we take out the trade with a time take profit, let's call it. So sure, it depends on whether we got stopped out before or not, but let's assume we didn't get stopped out. That means that we take out the trade then at 9:50 p.m. in my case, Central European time, so German time, Berlin time. So this is 10 minutes before Wall Street closes, to put it slightly differently. And also here, a chart, an example. So you can see this is an example from the, it's midst of July, it's the 17th or 18th of July. And there you have the range. These are the first 3 candles here of the trading day. So these red lines, the thin red line here, they define the high and the low of the range. And then you can see that we break out on the upside. This is the entry point here. This is the open range. We obviously trade above the blue line, which is the exponential moving average. So this is our advantage identification line, whatever. And we break out on the upside. So we take the long trade, and then here is the exit point. It's not based on a take profit level or something, but it's, as I said, the time take profit level. So 10 minutes before the market closed here, we took out the trade, which was, by the way, a great day because we nearly took out the trade at the high of the trading day. And so this is in fact the same example as for the DAX before, and you can already imagine that now if we do the same here for the before and after ESMA decision, we get a very, very similar approach. Nevertheless, we want to go through this, and then, by the way, one thing I want to write down here. 1 second. So what I want to do is I want to write down the margin requirement for the DAX and for the S&P. We want to sum this up then after. So what we do is here we take the DAX and then we take before ESMA. It's 195.53 euros, and then we take after ESMA. It's 984.72 euros. Okay, so we work with this a little later on. So now, again, we define the open range. This is the S&P example, 789.1, 796.5. So the open range at this in this example at this date was 7.4 points. Now the interesting thing is that here the point value of one SP 500 CFD is different. It's only 34 cents. And then what you can do is the S&P 500 trades obviously above the EMA 10 on a 15-minute time frame. So we trade only the long side in this case, yeah. And here again the calculation for the ESMA. Let's go through this again. You can see, by the way, it's not €1 as in the example before, because now we're talking about 2,790 around points, and it's in US dollar. So if you're located in the European Union in this case, you have to then calculate the euro value of this, and this is how those let's call it broken numbers come into play here. So you have to divide it in this case by 117. That was where is the current quotation of the euro USD in this case. So if you have to divide 2,800 here by 1.17. So I didn't work with 789, but I rounded it up to 800 in this case. So then you get the point value. It's or no, not the point value. You get the euro value of one SP 500 CFD. It's 2,393 euro. Again, we work with a leverage of 100 to 1. So the margin before ESMA for a retail client working with a leverage of 100 to 1 was 23.93 euros. So again, we assume we are trading with 10,000 euro account, and we are risking 1% per trade, equaling 100 euros. So we have to divide those 100 euros then by 7.4 in this case, because this is the width of the open range, and then you see that we can trade 13.5 CFDs in this case. So trading 13.5 CFDs means in this case that we have to multiply it with the margin requirement, 23.93, and this equals then to 323.38 euros. You have to put up in margin to trade such a position here based on this trading strategy, the open range breakout. So now we assume again, it's not the 17th of July, but it's the 17th of August. It's after ESMA, and now you have to, the leverage requirements or the margin requirements just increased, meaning that now you're only allowed to trade with a leverage up to 20 to 1. So then the margin in this case for the for one SP500 CFD needs to be divided, the value here, 2,393, you need to divide it by 20 instead of 100, meaning that for trading one SP500 CFD, you need to put up 119.65 euros. Yes, hello.
Just want to say that time is our limit. We have 15 minutes left, just for all that we know how long we have time, because 11 o'clock German time or 12 o'clock EET, our next webinar will start. So 15 minutes left, just for a watermark, or how you say it in English right now.
Yeah, I'll hurry up, I promise, because there's one very interesting chart we definitely need to show here. So assume 10,000 euro account, 1 risk per trade, 1% risk per trade, 13.5 CFDs. As you see, it's the same. The only thing is now we need to multiply those 13.5 with 119.65, and the margin increases, in this case, significantly above 1,000 euros, in this case, 1,615.28. So 5 times as much as this, also no big surprise, but again, more capital is bound when only trading this strategy, but the strategy is still and easily tradable because we are trading with a 10,000 euro account in this context. So now the interesting thing was that I already did the following. I entered those numbers here for the DAX in this case, in the Word document. And what you now can say is, and that's why we want to focus here after the ESMA decision, we'll bold this up and we'll make it here SP500. And we also use the after ESMA margin, which is 1,600.28. So what you can now see is that when trading both strategies, let's assume the following: you enter the trade, one trade in the DAX in the morning, and it hasn't hit the stop, respectively, the take profit level already when entering the second trade here based on the opening range in the S&P 500. You then will have 2 trades open, one at 984 euros margin, which is bound, and the next one is 1,615.28. As you can see, if you add those numbers up, you come up to, in fact, 2,700. It's a round number, 2,700 euros. So this is the overall margin required to hold both trades, 1% risk, 1 strategy each here. So you have to put up 2,700 euros to hold this position in this case, holding 2 positions here with the same strategy, but still you're not running into trouble because you still have a 10,000 euro account. So you can see if you work with 1% risk per trade and you have 1 trade per strategy, you're obviously not running into any difficulties. On Friday, we will see we run into difficulties because if we adopt this to a scalping approach then on a lower time frame, respectively trading with several ranges and not only one, we'll have up to 6 trades in both strategies combined, and then you need to multiply this number here by 3 again, and you will see that we'll then come out at 8,100. If you come out at 8,100 euros margin requirement, trading a 10,000 euro account, you start to run into trouble. Because obviously you only have 1,900 euros here left, and if there's, let's say, another trade on top of that, a swing trade in a currency market where you say it's a carry trade in, let's say, Australian dollar, US dollar, whatever, then things start to heat up a little, and this is probably the moment when, again, you have 2 choices: capitalize your account accordingly or reduce the position size. I'm probably not working with 1% risk per trade, but let's say trade with 0.5 or 0.3, so that 3 trades add up to 1%, something like that. You have to act accordingly. What we already did, and this is something I want to now make a topic here, the pros and cons of ESMA. So there's lots of discussions currently going on, and I have an own opinion on the ESMA decision. which is nevertheless a little differentiated. So it's not only that I say it's bad that the ESMA/Brussels took over here and really overruled the willingness of the retail clients. So there were several polls running showing that over 90% were against those leverage restrictions. And while I can completely understand this, on the other hand, and this is something the next chart will show, that the overall profitability is extremely affected by the leverage used by the retail client. And so I'm a little, yeah, it's back and forth for me. So I can, on the one hand, understand that the leverage restriction is something which is not seen as very positive, because you, for example, also have to have more money in your trading account. There, again, especially brokers like Admiral Markets have a big advantage compared to many competitors based on the regulatory aspects with the FCA regulation, for example. So segregated accounts and all this. This is something where the work of the last years, especially for those brokers putting an effort here to achieve all this, now starts to play out. Nevertheless, I can, on the other hand, understand retail traders who say, well, I want to trade more strategies, or I don't want to place or deposit so much money in my trading account. So on the other hand, it's all about making money, and the chances of making money increase by a decrease in the leverage. So now I will bring up some pros and cons, which I consider to be worth at least considering, let's say. So first thing was already mentioned several times, the lower leverage increases chances of being profitable. The next chart will show you exactly that. And it's exactly what Jens already said at the beginning, when he said a chart in this case, or a picture, says more than 1,000 words, something we will see in a few seconds then. But this is probably even more important here. What you have seen here is now we're nearly talking about 1 hour of only a very simple trading approach, which you nevertheless have to study in depth, not only formulate it to have clear rules to enter, exit the market, but you have to really think of it also from a risk and money management perspective, and how to which position size to use. And this goes hand in hand with having already, or developing a deep knowledge about key parameters of one's trading, which is necessary to take then adequate steps. For example, focusing on a balanced strategy mix, for example, on personal risk parameters, reducing the position size. And all this is really professional and something really positive. On the other hand, I have to say, I'm not really sure whether the ESMA took the decision with, let's say, forcing retail traders to their luck, let's say, and really take a deep look into their strategies, but really just did it, yeah, based on probably political reasons, but this is another topic. If you want to see something very positive out of this ESMA decision, draw a positive conclusion, I think it's that you have to really understand what you're doing, and to in depth understand your strategy, and really go in details around your risk parameters you're using in your trading. The cons, also already mentioned, is that more capital is required in the trading account, even though I put a question mark here for a simple reason, because is it really necessary to have more capital in your trading account? Based on the two strategies and the approaches I just formulated, it's obviously not necessary, because with a 10,000 euro account, for example, and you can easily reduce this. Let's say it's not a 10,000 euro account, but in this case, then let's say it's a 5,000 euro account. You divide this number by 2. Even with a 5,000 euro account, you could afford trading those two strategies, since the margin requirement is 1,350 euros. So it's not necessarily said that you really have to put up more money in your trading account to afford trading those strategies. And that's what I mean with depends on trading strategy. But now let's come to the nominal versus effective leverage. And I don't want to go into too many details here, but I want to work with a chart in this case. Nevertheless, a first introduction definition is nevertheless necessary. How can the reduction of the leverage increase the overall chances of being profitable? That's the question. And there's the so-called effective leverage where it comes into play. And the effective leverage is in fact not the leverage which is now brought up from the ESMA, but nevertheless it directly affects the effective leverage. The effective leverage is calculated by the position size you trade. In our case, for example, position size we trade when saying we trade the DAX here at 12,800 points, and we traded, in this case, we trade 2 contracts. We are moving, let's do it here. We are moving 12,800 multiplied with 2, so 25,600 euro. So this is
now we really have to speed up. We have 3 or 4 minutes more, so maybe a little bit more speed. Unfortunately, we have a hard deadline today with the time. I guess we have another more important slide prepared about the leverage effect in the real life. Maybe we can speed a little bit up.
Yes, yes. So effective leverage, 25,600 in the DAX. We divide it here by 10,000, so then it's 2.5 to 1 in this case. And now the question is, how do nominal and effective leverage interact with each other? The higher the nominal leverage offered by the broker, the higher the chances that you use it. It's like, it's a very blunt example, but I think it gets the story done. It's like giving a box of candy to a 5-year-old and telling him not to eat everything at once. And this is the effective leverage in the real world. You can see on the x-axis here that the lower the effective leverage, so that means you have to go to the left in this case. So in this case, it's smaller 5 to 1. And here is the overall profitability of the traders, that it goes up to 40%. So the lower the effective leverage, the higher the chance that the trader is profitable. Or other way around, the higher the effective leverage, the lower the chances that the trader is profitable. And this is in fact based on a series of trades. So we are looking here at an example of over 10 million trades, which were calculated by a broker. We don't want to name the broker here. It's for discretionary reasons. It's not Admiral Markets. Nevertheless, that was a research done by this broker, and I came across this, and this is one of the reasons why I all the time recommend reducing the overall leverage in your trading, and why the ESMA decision, all in all, increases the chance of the longevity of retail traders, in fact. So yeah, you probably just want to screenshot this and have a deeper look at it yourself, and remember this chart all over and over again when trading in the future. So it's not all bad around the ESMA decision, even though adaptations are necessary. And in fact, that's it now from my end.
Next slide, please. So bottom line, it's not a secret. We say it usually in all webinars. Chances and risk goes hand in hand. If you have a leverage of 10 or 20 or maximum 30, then of course your potential profit is also limited, because the leverage effect multiplies your profit chance. But on the other hand, if your leverage is just 10 or 20 or 30, also it limits the potential loss. And of course, in the old world, as a retail client, if you have a leverage of 100 or even 500, your potential profit is multiplied by 100 or 500, but also your potential loss. That is not a secret, but sometimes we have to point it out again, because that is the magic point why you trade leverage products. Bigger chances means always bigger risks, and more about that in the next special webinar, what we're having on Friday. Then more about trading strategies, more about scalping, more about all other stuff. The time is our hard limit. So next special webinar, Friday, depends on your time zone, 10 o'clock German time, 11 o'clock EET. Yeah, hope to see you all again. If you'd like to see that webinar again, a couple of hours later, it will be available on our YouTube channel. Thanks to Jens, thanks to all of the live participants, and next webinar in 1 or 2 minutes, real-time daily trading ideas about the market. Thanks a lot, and hope to see you all again on Friday. Bye-bye.